Welcome. This is question Lab 4, question 3, and we're preparing a statement of cash flows, just the operating activities section. And we've got a bunch of information, and assumes that all sales are on credit, where all credits to accounts receivable are receipts from customers, purchases to merchandise are on credit, purchases of merchandise are on credit, accounts payable results from purchase of payments for merchandise, and we'll forget about the required disclosures for cash flows associated with interest paid and received, and income taxes. So we're basically taking a fairly straightforward approach to the statement of cash flows. We're given an income statement here, and we're going to prepare a statement of cash flows, and we've got a question at the end that I think we can probably answer right now. It says, how will the net cash flow from operations compare to the accrual-based net income? It could be higher or lower, depending on a number of things. So the correct answer would be net cash flow from operations may be greater or less than accrual-based net income. So you've earned 1 mark out of your 11. This is a fairly large question for 11 marks. So we'll see how it goes. We are putting together a statement of cash flows, so what I usually do is I try to get as many of the headings as possible. So we're going to start with, this is just the operating activity section, so we want cash flows from operating activities. Then we're going to put in the net income next, and so that doesn't show up here, so we'll have to go down to, well, let's just search for it, net income. There we go. And then we are going to subtract the heading called non-cash items adjusted from net income, and that will include all of the items here that are not supposed to be included in the operating activities. So we're basically starting with the assumption that net income is all cash, and then we adjust for all the things where that's not true. So that will include the gain on sale of land. It'll include the investment income from the investment in the associate, because that's an investing activity, depreciation expense. All the rest of them, net sales, of course, is cash. Interest income is cash. Cost of goods sold, essentially cash. And interest expense, essentially cash. And income tax expense, essentially cash. So that's all of those items. And then we need to adjust for the cash in or out from operating working capital. So that would be including all of the changes in all of the partial balance sheet items down here. And we need to inspect them all and put in the appropriate heading for them all. So let's, for accounts receivable, that looks like it's gone down. So 118 down to 117. So we need decrease in accounts receivable. We can actually see that in the screen here, so I'll just click on it. And then the inventory has gone up, so that's an increase in inventory. So let's scroll down. There we go, increase in inventory. And then we have a decrease in prepaid insurance. There we go, decrease in prepaid insurance. Our accounts payable has gone up. So it's an increase in accounts payable. Whoops, there we go, that's the one we want. And then we have an increase in unearned revenue. There we go, a little scrolling for that one. Interest payable went up by $100. That's not very much of an increase, but it is an increase. And so we're looking for interest in interest. There we go, interest payable. And that will be all of them. So then the, whoops, don't know what happened there. Wrong button. Headings and totals, that will be net cash from operating activities. And that should take care of everything. So let's just drag across our net income, 246,300. Our gain on sale of land, we're going to need to undo that, so we're going to need to subtract it. So let's go home and hit the minus sign. We need to undo the gain on sale of land, so since it's been added, we need to subtract it. The investment income, same story. Whoops. That's not what I expected to happen. Let's grab that. Okay. And once again, hit home and minus. So we need to undo the investment income. And the depreciation expense, of course, was deducted, so we just add it in. Oh, some interesting things happening here in my lyrics world. There we go. And then we have all of the cash in and out from the operating working capital. There's a few ways you can do this. You can calculate the increase or decrease and just use the 2x2 box that we talked about in class. So a decrease in accounts receivable, of course, frees up cash, so that's a good thing. Increase in inventory means we're buying more inventory, so that's going to cost us cash. So an increase in a current asset costs us cash. A decrease in a current asset releases cash to us. An increase in accounts payable means that we are borrowing money, so that gets us cash. A decrease in a liability, a current liability, costs us cash because we're paying off the liability. So that's one way of dealing with it, just use the 2x2 box. Another way that I found quite helpful is to actually calculate the balances indicating kind of what happened to them. So the accounts receivable, we started with 118,400, and presumably we collected that, right? So that's going to be an increase. So I'll enter that with a positive sign, which you can't see. But then we lent our customers 117,600 in the second year. So in 2015, we lent them 117,600. So they have a bunch of our cash. The net effect is a decrease in accounts receivable increases the amount of cash that we have by 800. For inventory, we sold the 112 that we started with. So that's going to generate cash. And then we bought a bunch of new stuff, 115,800 of new inventory. The net effect of that is that it reduced the cash we have by 3,800. Decrease in prepaid insurance, the same idea. The 21,400 was used during the year, so we basically collected the value of that through use, and then we bought some new prepaid insurance for 18,800 during 2015. For accounts payable, we started by paying off the 20,800 from 2014. Whoops, you can't see that. And then, of course, we oh, that should be a negative number. Okay, so as I said, we paid off the 20,800, which cost us cash to do, and then we borrowed another 23,800, which brought us cash. Same deal with unearned revenues. We paid off the 17,700, presumably by doing the work during the year. But then we borrowed another 22,600 from our customers, and we owe them the work or the cash back. Interest payable, we paid off the bill for the 16,100 we owed at the beginning of the period, and then we borrowed another 16,200 during the period, giving us cash. So now we've got all of the items filled out, and we've gotten all the way to the end of the income statement. So we've got all of these pieces. That's all the income statement items that needed adjusted. And then we've got all these working capital items. We've included all of them. So there are 6 entries here, and there are 6 lines here, so we know we're all done. Now we just need to add up the numbers. So let's just quickly do that. So when I do all of that, I drag it aside here, I just added up all of the items on the list, 246,300 all the way down to the 100 at the end, and I get 109,500 as the net cash from operating activities. I've got all of my headings there. I've got the Part B answer completed here. So let's see what Lyrics thought of our attempt. Lyrics apparently agrees. Our total marks for this question are 11. We are done.